Welcome to vTalkInsight, Market Drivers Daily for April 24th, 2026. Brent crude is back well above $100 on sustained Gulf tensions, while semiconductor stocks extend a record-winning streak on AI enthusiasm. Today, the key question is whether this tech leadership can keep carrying risk assets as the oil shock, inflation risks, and delayed rate cut expectations all intensify. Geopolitics in the Gulf has shifted from a short disruption risk toward a more persistent supply shock, with the Strait of Hormuz effectively constrained and no clear path to a durable settlement. Oil exports through the strait are nearly halted. Gulf crude output is down more than half from pre-war levels, and estimates point to a global production shortfall of around 14.5 million barrels per day when you include wider regional disruption. That physical squeeze is now fully visible in prices. Brent has jumped about 16% in just 5 days and roughly 18% this week, is trading well above $100 and has risen around 45% since February. Forward curves are also reflecting a durable risk premium, with long-dated WTI contracts at cycle highs into the autumn, signaling that markets see geopolitically driven tightness lasting beyond the immediate headlines. The macro fallout is sharpest in Europe, which lacks a large domestic energy base or a deep tech sector to offset the hit. European equities are underperforming the U.S., with benchmarks like the Euro stocks down this week, while only energy names show notable resilience. And there are signs of stagflationary pressure in Germany as higher input costs meet already soft activity data. Developed market inflation is now expected to push back toward or above 4% in coming months, led by energy, even if pass-through into core measures stays more contained. Policymakers are reacting, but in a fragmented way. In the European Union, targeted energy support is being prioritized because fiscal space is tight, while debates over looser fiscal rules and possible windfall taxes on energy companies are intensifying. At the same time, governments are committing to higher defense spending and have approved a €90 billion loan package to Ukraine, adding to long-term fiscal expansion even as central banks face pressure to keep rates elevated. In the U.S., the combination of stubborn energy-driven inflation and Middle East uncertainty is pushing expectations for Federal Reserve rate cuts towards September or later, and some commentary suggests current cut pricing may still be optimistic. There's a counter-narrative that the system is adapting better than feared. Tankers are rerouting around the Cape. U.S. export waivers are offering limited relief, and some analysts argue that only meaningful demand destruction in the U.S. and Europe will ultimately rebalance the market. For now, however, European equities, airlines, and energy-intensive sectors are carrying most of the risk, while U.S. indices remain cushioned by tech giants whose earnings are less directly tied to fuel costs. The key watch points are any memorandum of understanding to ease the Hormuz blockade, shipping and inventory data into the summer, and whether higher energy costs begin to show up decisively in core inflation and consumer demand. Against that still volatile macro backdrop, the second major story is how the AI build-out is reshaping corporate spending, labor markets, and credit. The AI theme has evolved from a narrative about potential into a capital expenditure and earnings reality, with large companies racing to secure compute, power, and talent. AI-related CapEx is reported to be up around 60% year-on-year, driven by hyperscalers expected to spend hundreds of billions of dollars on chips and data centers, and that surge is flowing through to equipment makers, grid infrastructure firms, and legacy technology providers. A key shift beneath the surface is that demand is rotating from pure GPU-heavy training towards CPU-driven orchestration and inference workloads. Intel has delivered its largest revenue beat in years, with guidance as much as 14% above prior expectations, and its share price has reacted with single-day gains in the 20s as investors focus on surging server CPU demand linked to AI inference. Commentary suggests that the ratio of CPUs to GPUs in data centers is improving, implying that the AI hardware trade is broadening beyond NVIDIA-style training chips to a wider set of compute vendors, including names guiding for strong multi-year growth in both CPUs and GPUs. On the software and enterprise side, AI-driven demand is supporting earnings for firms like SAP, which has beaten expectations and eased fears about disruption, while also moving toward more usage-based pricing for AI services. Companies using AI to streamline complex, high-assurance processes are gaining market share, and M&A workflows are already seeing deal preparation times cut by up to 30%, with expectations that AI tools will handle a much larger portion of post-merger integration. At the same time, commentary highlights that companies without a credible, implemented AI strategy by year-end may face a valuation discount as capital increasingly favors demonstrable AI integration. These investment plans are reshaping labor and funding markets. Major tech firms such as Meta and Microsoft are cutting a combined 23,000 jobs and using early retirement offers, particularly for staff less involved in AI, to free up budget for massive GPU and data center spending. In credit, AI and data center-related high-yield issuance has grown from zero to a small but visible share of benchmarks, with some deals underperforming even as overall high-yield supply is well absorbed, and a $300 billion AI partnership has already strained bank loan syndication capacity. Security risks are also rising, illustrated by reports of unauthorized access to Anthropic's Mythos model, which has fueled both high valuations and serious questions about cyber resilience across the AI ecosystem. Macro implications are finely balanced. On one hand, AI-driven productivity gains and strong earnings beats from chipmakers and software providers are helping equity markets look through geopolitical noise and support the view of robust growth into the next decade. On the other, the huge capital demand for AI infrastructure, alongside higher energy and wage costs, is complicating central bank plans and may keep interest rates higher for longer than earlier assumed. Many of the benefits to labor markets and consumer spending are likely to appear only gradually, while near-term impacts include job cuts, sector-specific credit stress, and questions around monetization for high-profile private AI names with steep valuation expectations. The next key catalysts are earnings and CapEx guidance from the largest hyperscalers, how they balance spending with margins, and whether regulators and corporates move decisively to address AI-related cyber and governance risks. All of this feeds directly into the third storyline, which is how AI has come to dominate the equity tape. Equity indices are printing fresh records, but the leadership is unusually narrow and heavily concentrated in semiconductors and AI beneficiaries. The Philadelphia Semiconductor Index has surged more than 40% in less than 3 weeks, notching an unprecedented 17 to 18 consecutive daily gains and recording its strongest single-day move since the late 1980s. Old guard chip makers like Intel and Texas Instruments, once seen as ex-growth, are now at the center of this move, with Intel in particular posting an earnings and guidance beat that pushed its stock up by more than 20% in a single session and to all-time highs in subsequent trading. Under the surface, investors are rotating from software and speculative growth toward hardware, infrastructure, and cash-generative platforms tied directly to AI build-out. Semiconductor earnings upgrades, improved return on investment for AI infrastructure, and sustained CapEx by hyperscalers are all contributing to this shift, and some strategies now focus on more targeted exposure to U.S. technology, including via options, as realized volatility has moderated. At the same time, there are signs of profit-taking, with semiconductor exchange-traded funds seeing outflows even as the underlying stocks rally, suggesting that some investors are locking in gains while others continue to chase momentum. This tech-heavy leadership is creating pronounced regional and sector divergences. U.S. benchmarks like the S&P 500 and NASDAQ have notched multiple record weekly closes, with roughly 80% of reporting companies beating earnings expectations and technology and chip names doing most of the heavy lifting. In contrast, European equities are down around 3% this week, with weakness broad-based outside energy, reflecting the drag from higher oil prices, weaker purchasing managers' data, and the absence of a deep domestic AI hardware complex. Energy-intensive sectors such as airlines and traditional industrials are facing rising fuel bills and, in some cases, guidance cuts, even as Middle Eastern energy producers press ahead with long-term projects and contracts tied to expected post-conflict demand. The central question is how sustainable this pattern is. Market narratives point to a technology revolution that could drive robust economic and equity gains into the 2030s, and valuations for many AI leaders still assume persistent growth and high margins. However, risk premia in parts of the equity market are at multi-decade lows despite ongoing conflicts, an unresolved oil shock, and potential for further rate or bond volatility. There are also concerns that high energy prices could eventually squeeze the very sectors now leading, given the energy intensity of data centers and chip fabrication, while concentrated leadership increases vulnerability if sentiment around semiconductors or AI capex were to shift. Looking ahead, the busiest stretch of large-cap tech earnings, including Meta, Microsoft, Amazon, and Alphabet, will be critical in validating or challenging the current rally, especially as these firms collectively plan to spend around $650 billion on AI this year. Guidance on capex, margins, and labor plans, alongside results from major energy producers and airlines, will help clarify whether the equity market can broaden beyond today's semiconductor core or remains reliant on a relatively small group of AI beneficiaries. For now, the tape suggests that strong tech earnings and AI optimism are offsetting geopolitical and energy concerns, but the balance between concentration risk, valuation, and macro uncertainty remains finely poised. To sum up, Gulf tensions and a constrained Strait of Hormuz are keeping oil above $100, lifting near-term inflation risks and weighing particularly on Europe, while central banks face mounting pressure to stay restrictive for longer. At the same time, AI investment is reshaping corporate balance sheets, labor markets, and credit, with CPUs, data centers, and grid infrastructure emerging as key winners, even as security concerns and lofty private valuations add new layers of risk. Equity indices are riding a remarkably narrow, semiconductor-led rally that has delivered record highs, but also heightened concentration and sensitivity to any shift in AI capex or rate expectations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.